After doing the company analysis, now we will learn something about the estimation of intrinsic value. Now, once the analysis of the economy, industry, and company is completed, the analyst can go ahead with estimating intrinsic value of the firm's stock. Price and value are two different concepts in investing. While price is available from the stock market and known to all, but value is based on the evaluation and analysis of the entity that is undertaking the evaluation of the stock at a point in time. It may be noted that price is a fact, but value is an opinion. I will say it's one more time that it may be noted that price is a fact, but value is an opinion. So there are various approaches to valuation. They are explained in the I will explain it in subsequent videos. So there are uncertainties associated with the inputs that can go into these valuation approaches. As a result, with due diligence, the final output can at best be considered an educated estimate. So that is the reason valuation is often considered an art as well as a science. It requires the combination of knowledge, experience, and professional judgment in arriving at a fair valuation of any asset. The purpose of valuation is to relate the market price of the stock to its intrinsic value and judge whether it is fairly priced, overpriced, or underpriced. So, three most popular approaches to valuation are discounted cash flow approach, which we will learn in today's video, acid based approach, second video, and relative multiple based approach that we will learn in third video. So let us start with the discounted cash flow model. Conceptually, discounted cash flow approach to valuation is the most appropriate approach for valuations when three things are known. The first is the stream of future cash flows, timings of these cash flows, and expected rate of return of the investors, called discount rate. So once these three pieces of information are available, it is simple mathematics to find the present value of these cash flows with a potential investor would be willing to pay today to receive the expected cash flow stream over a period of time. So typically, any investment involves the outflow of cash. Later, the investor expects cash inflows during the investment horizon. Finally, at the time of disinvestment, the investor expects a large cash inflow, preferably larger than the original investment, so representing the return of original investment with some appreciation. So the same framework can be applied to valuing businesses. Popularly, profits are compared to the regular inflows from traditional investment. However, it should be appreciated that profits are accounting estimates rather than facts, because accounting standards and tax authorities permit accrual accounting. Accrual accounting means uh, income is earned but cash is not received, but also we record it. So there can be many valid adjustment to the figure of profit without any involvement of cash flows. Therefore, profits in business and returns in the form of cash flows in financial investments are not comparable. This gave birth to the philosophy of estimating cash flows in business from the profit figures. Now, how to do it? I'll say something about it. So, business valuation professional applied the philosophy of discounting to valuation of business entities, drawing from the postulates of time value of money and the fundamental framework that the intrinsic value of any asset should be equal to the present value of future benefits that acquire from owning it. So, for instance, when one holds a real estate like land and buildings, its value should logically depend on the future rental income and resale value that could be generated from it, measured in present value terms. So, in case of a bond, the intrinsic value of a bond should depend on the future coupons and the redemption value. Coupons means the interest that we get from investing in the bond, and the redemption value is the value when the company redeem the bond and give back the money to the bondholder, measured in terms in present value terms. So in both the cases, the entity that estimated the intrinsic value uses a particular discounting rate, which includes the minimum risk-free rate, the compensation for the term period of the investment, the premium for the asset specific risk, the transaction cost, and the taxes. So the aggregate of all these components are referred to as required rate of return. However, in common parlance, the transaction cost and taxes are taken as given, so they are ignored. So extending the logic to business valuation or equity valuation, the investor should logically discount the future benefits accruing to the business or by being an equity investor. So in case of a business that has not taken any debt in its capital structure, the entire profits belong to the owners. However, when the company engages borrowed capital in the business, that's the capital, they changes the capital structure, then the lenders also have a claim in the assets and profits of the business. So if booked profits are considered to be future benefits, the earning before interest, tax, depreciation and amortization are the profits left for both the lenders and owners to share along with government for tax. Earnings after tax, that's EAT or PAT, are the profits left for only the owners of the business, as other stakeholder, lender and government have taken away their dues. So as discussed earlier, the inherent weaknesses with the EBITDA and EAT figures, valuation experts preferred cash flows versions of the two accounting figures mentioned above. That is, the FCFF represents the cash flow left for both the lenders and owners, out of which lenders can take their interest and principal repayments and the owners can take their dividends. So FCFE represents the cash flow left only for the owners of the business. Therefore, depending on the purpose of valuation, that is to value a firm or equity, either FCFF free cash flow for firm or FCFA free cash flow for equity is used respectively. So for the calculation of free cash flow for a firm, I will give in description about this formula and I will explain sometime. So free cash flow to firm for a future year is calculated as expected EBIT 1 minus tax rate plus expected depreciation plus expected non-cash expenses minus expected capex by the firms minus expected increase in working capital. For the free cash flow for equity for a future year is calculated as expected EBIT minus interest expense into 1 minus tax rate plus expected depreciation plus expected non-cash expenses minus expected capex by the firms minus expected increase in working capital minus expected debt repayments plus expected fresh borrowings, or we can calculate is as expected free cash flow to firm minus interest expense into 1 minus tax rate plus expected fresh borrowings minus expected debt repayments, or we can calculate in third like a free cash flow for equity expected free cash flow to firms minus interest expenses into 1 minus tax rate plus expected net debt issues, or when the company has preference shares also in the capital, it is calculated as free cash flow to firm is equal to expected free cash flow for firm minus interest expenses into 1 minus tax rate minus expected preference dividend plus expected net debt issue plus expected net preference shares issue. So apart from depreciation, other non-cash charges include amortization of intangible assets and loss on sale of assets which are added back. Unrealized gains on assets are deducted from the FCFF and FCFE calculations. So the FCFF, that's free cash flow for firm, and free cash flow for equity figures are known as free because all the other stakeholders leaving the financiers of the business are paid their dues before arriving at the figure. Further, the business is also treated as a stakeholder, and the funds required for its growth and sustenance are also provided in the form of capex and working capital. Therefore, what is left is for the financiers to claim free of all encumbrances. So rarely free cash flow for firm may be negative, but there are reasonable chances that free cash for equity may be negative. In such cases, the free cash flow for firm may be used for valuing the firm, and then the value of equity can be calculated by deducting the value of debt from it. So, valuation requires forecasting cash flows into the future. This can be done by applying historical growth rate exhibited by a company or a rate estimated by the analyst based on their information and analysis. So, this is known as the discount rate. So this known as the growth rate, but I will teach you this growth rate in second video. And this is the completion of the cash flow. That in this video we have learned about the discounted cash flow approach to value to give a intrinsic value. So we have learned about how to calculate the free cash flow for firms and free cash flow for equity, and how to come from the net profit or EVIT to the free cash flow to firm, EVIT to free cash flow to firm, and from free cash flow to firm to the free cash flow for equity. So it will be used in the calculation of intrinsic value. So this is this is the first video of DCF analysis, that is discounted cash flow theory. And please like, subscribe and comment about this if you feel it nice. Okay.